Ever wondered how startups like Uber, Airbnb, or Tesla got the money to grow into billion-dollar companies? The secret is venture capital. But what exactly is venture capital and how does it work? Let's break it down in simple terms. Venture capital, VC, is a type of private investment that helps early-stage startups grow by providing them with money in exchange for equity, ownership shares. VC firms invest in businesses they believe have huge growth potential, hoping to make big profits when the startup succeeds. Why do startups need venture capital? They need funding for research, hiring, and scaling. Banks won't give loans to risky startups. VC firms take the high risk for high rewards. Venture capital funding happens in stages. Seed funding. The startup is just an idea. Investors provide the first money to get started. 2 series of funding. The company has a product and customers. Investors give millions to scale the business. 3 Series B, C, and beyond. More funding rounds help the company expand globally, hire more employees, or develop new products. The goal? To grow so much that the startup gets acquired or goes public, IPO, making investors huge. Returns. Venture capitalists, VCs, are investors who fund startups in exchange for equity, ownership. Some of the biggest VC firms in the world are Sequoia Capital, invested in Apple, Google, and Airbnb. Andreessen Horowitz, invested in Facebook, Coinbase, and Slack. SoftBank Vision Fund, invested in Uber, WeWork, and Alibaba. These investors take big risks, but if they pick the right startup, they can make billions. VCs make money when startups exit through IPO, initial public offering, when a startup goes public on the stock market, e.g. Facebook, Tesla. Acquisitions, when a big company buys the startup, e.g. Google bought YouTube for 1.6 billion. Mergers and buyouts, when another company or investor buys VC shares for a profit. If a startup succeeds, VCs can make 10x or even 100x their original investment. But not every startup makes it. In fact, 90% of startups fail. Some never become profitable. VCs lose money if the startup fails. Founders lose control because VCs own part of the company. It's a high-risk, high-reward game, but when it works, it changes industries. Now that you understand venture capital, would you take VC funding if you had a startup? Let me know in the comments. And if you found this video helpful, don't forget to like, subscribe, and hit the bell for more business and finance insights. See you in the next video.